The Chinese electric vehicle industry is facing a critical turning point. At the end of May, the Ministry of Commerce convened an urgent closed-door meeting, spotlighting major automakers like BYD, Dongfeng, and Great Wall. The discussion centered on the issue of zero-kilometer used cars, a term that may seem minor but is exposing a profound vulnerability in China's auto industry. We have reached what many are calling the Evergrande moment for Chinese automobiles. Over the past 3 years, when ordinary families shared photos of their new cars on social media, those moments often masked a purchase driven by financial leverage. Now, the truth has emerged. Many of these new vehicles had been sitting in warehouses for over 300 days, registered by automakers, nominally sold, and then quietly resold as zero-kilometer used cars. Why? To inflate sales figures, bolster stock prices, and secure government subsidies. BYD is not alone in this practice, but it stands at the epicenter of the storm. Recently, the company unleashed another round of aggressive price cuts, affecting 22 models. For instance, the sealed dual-motor hybrid sedan's price dropped from 156,000 yuan to 103,000 yuan, a reduction of over 34%. However, to access this price, buyers must trade in their existing vehicle, even if it's still in good condition. This brutal price war has no victors. On May 26, Hong Kong's auto stocks plummeted. BYD's shares fell 8.6%, Geely Automobile dropped 9.5%, Leapmotor declined 8.5%, Great Wall Motor fell 5%, and companies like Li Auto, Xpeng, NIO, and Xiaomi each saw losses exceeding 3%. In a single day, the price war erased tens of billions of Hong Kong dollars from the industry's market value. Why is this price war so devastating? The numbers paint a grim picture. According to the China Automobile Dealers Association, in the first 8 months of 2023 alone, price wars caused direct losses of 138 billion yuan, driving industry profit margins below 3%. By 2024, the average profit margin per vehicle had fallen to under 2.1%. Emerging brands like Leapmotor and Xpeng are losing over 10,000 yuan per car sold. This relentless race to the bottom saw average selling prices drop from 220,000 yuan to 140,000 yuan in just 1 year. This is not competition, it is self-destruction. At the end of May, Great Wall Motor's chairman Wei Jianjun issued a stark warning. He stated that pure electric vehicles are not a sustainable business model. In an almost desperate tone, he noted that capital has already reaped its profits and withdrawn, leaving automakers to sell cars at a loss while dealers struggle with unsold inventory. He compared the current state of the auto industry to Evergrande before its collapse, a disaster waiting to happen. This is not mere alarmism. Recall Evergrande's playbook. Inflated sales figures to win market confidence, repeated loans backed by mortgaged assets, and reliance on subsidies and cheap credit to sustain high-leverage operations. When the market faltered, it collapsed, impacting suppliers, consumers, and the broader supply chain. Today, China's leading electric vehicle manufacturers are following a disturbingly similar path, fabricating sales, disguising unsold inventory as used cars to secure bank loans and subsidies. Each car becomes a financial instrument with consumers left bearing the consequences. Wei Jianjun is not irrational, he is simply exposing a massive deception. Behind the scenes, China's auto supply chain is being slowly suffocated. Data from Wind shows that, as of the first quarter of 2025, the average accounts payable period for China's 16 major listed auto companies is 182 days, double the global average. This means that suppliers providing parts to companies like BYD may wait 6 months for payment. Meanwhile, suppliers face annual price cuts of 10% to 20%. Hundreds of smaller suppliers have been forced to exit the market. BYD dealerships such as Shandong Qiancheng Holdings and Liaoning Xingqi have been closing at an alarming rate. Individual stores are burdened with 2.5 months of inventory, well beyond the 1.5-month warning threshold. Dealers earn less than 3,000 yuan in profit per car, and any dip in consumer demand pushes them into losses and closures. BYD and its competitors are dragging the entire supply chain into a downward spiral with ripple effects that will erupt at a breaking point. Ironically, registering new cars and selling them as used has become an unspoken industry standard. Why? To polish financial reports. Once registered, a car counts as sold, qualifying for subsidies, improving inventory figures, stabilizing stock prices, and reassuring banks to extend credit. But who ultimately pays the price? the millions of ordinary Chinese who believed they were purchasing a new car. The China Automobile Dealers Association reports that in 2024, the zero-kilometer used car market exceeded 1.1 million vehicles, with brands like BYD, Geely, and Great Wall dominating. Buyers of these cars face rapid depreciation, unclear warranty responsibilities, limited after-sales support, and, in some cases, insurance companies refusing claims. This is not merely unethical business, it is a legalized fraud built on financial leverage and subsidy schemes, a symptom deeply rooted in Chinese manufacturing. The Chinese once took pride in their domestic cars, their electric vehicles, and BYD, China's answer to Tesla. Yet the reality behind this new energy myth is a fragile house of cards, propped up by fraudulent subsidies and price wars. A single disruption could bring it crashing down, with BYD as both the most prominent and potentially the most vulnerable player. Research from AutoHome indicates that by the fourth quarter of 2024, over 60% of Chinese auto dealers were operating at a loss, with new energy vehicle dealers facing a 70% loss rate. For BYD, relentless price wars have reduced dealer profit margins to less than 2,500 yuan per car. A veteran salesperson on Zhihu shared that some dealerships sell only 5 or 6 cars a month while being saddled with inventory targets of at least 20. Each sale results in a loss, and every day they operate, they hemorrhage money. This is not an isolated issue. Data from the China Automobile Association and the China Automobile Dealers Association shows that in 2024, over 420 Chinese auto dealers closed, with BYD leading in electric vehicle dealership closures. Yes, BYD, the company many thought was conquering global markets, is quietly shuttering stores at home. Zero-kilometer used cars are the key to unraveling this crisis. Insiders confirm that registering and then scrapping cars has become an industry norm. Automakers instruct dealers to disguise new cars as used to complete nominal sales, claim subsidies and secure bank credit, then sell these vehicles at discounted prices. Great Wall's Wei Jianjun admitted in a CCTV interview that thousands of dealerships engage in this practice. Why? It's all about money. An unsold new car is a liability, a loss, a drain on liquidity, but once registered, it becomes a sale, boosting stock prices, stabilizing market value, and serving as collateral for loans and subsidies. It's a numbers game that creates the illusion of growth in financial reports. This practice of turning new cars into used cars and inventory into assets mirrors tactics long used in the real estate sector, now permeating the electric vehicle industry. BYD, Geely, Leapmotor, Xpeng, none are truly exempt. They are all complicit, pretending sales are robust, deceiving policymakers, shareholders, the market, and themselves. Foreign capital is withdrawing and international markets are turning hostile. BYD's global ambitions are fading rapidly. In April 2025, the EU imposed punitive tariffs of up to 35% on Chinese electric vehicle exports, citing unfair subsidies, effectively strangling BYD's European prospects. The U.S. Inflation Reduction Act bans Chinese-linked electric vehicle and battery companies from its market, blocking BYD's path in North America. Emerging markets like India, Vietnam, and Indonesia are following suit, erecting barriers to protect local brands. While many believed BYD was conquering the world is closing its doors to BYD. The golden era of Chinese auto exports is ending swiftly. The Evergrandeization of the auto industry appears inevitable. Is BYD the next Evergrande? This question is increasingly common on platforms like Zhihu, Weibo, and Huxiu, not as doubt, but as fear. Reflecting on Evergrande, the parallels are striking. Frenzied financing, aggressive expansion, reliance on subsidies and loans to inflate performance, all concealing a financial abyss. When it collapsed, stocks fell to zero, debts defaulted, and millions were left in ruin. In the first quarter of 2025, BYD's financials revealed accounts receivable soaring to 112 billion yuan, a 19.3% increase from the prior quarter, well above industry norms. Many dealers report delayed payments after registering cars, leaving their cash flow precarious. More alarmingly, BYD's debt-to-asset ratio reached 68.2% in Q1 2025, a 5-year high. This is a textbook high-leverage company. A drop in sales or a cutoff in subsidies could trigger a rapid capital exodus, just as it did with Evergrande. Who will bear the cost of this bubble? China's electric vehicle industry is not driven by innovation, but by massive subsidies, excessive financing, and a facade of prosperity. In 2024, the government allocated 84.2 billion yuan to EV subsidies, Yet industry profits fell 37% year-on-year. Losses persist despite subsidies, and subsidies continue despite losses. A bottomless pit consuming government funds, bank credit, and ordinary people's savings. The tragedy is that when this bubble bursts, the automakers, executives, and investment banks will not pay the price. It will be ordinary Chinese citizens, young people repaying car loans, middle-aged families who bought overpriced older models, dealers crushed by closures with no recourse, and supply chain workers facing delayed payments, factory shutdowns, and layoffs. They will bear the true cost of this collapsing myth. China's auto industry is treading Evergrande's path. Fabricated prosperity, over-leveraged financing, exploitation of dealers, corner cutting, and falsified financials. You may choose not to buy a car, but you cannot ignore the warning signs. When a nation's supply chain fails, the entire economic system suffers. This is not merely BYD's problem, nor Great Wall's or Geely's. It is a crisis of confidence in Chinese manufacturing. Subsidies cannot sustain the future, illusions cannot mask the crisis, and the bubble is already cracking. Is China prepared? Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.